Hey everyone, welcome back to the channel. This is your weekly update on my 15,000 trading challenge, and I've got a lot to share with you this week. The market has been tough with the high volatility, and my portfolio is slightly down by 0.35%, dropping from 15.17% to 14.82%. And this is from around mid-December to currently. I'm recording this video on the 27th of March, 2025. But this isn't about bad trades. It's because I adjusted my trading strategy this week. So stick around because I'll break down my new approach, explain my long vertical core positions, and share some key lessons that I learned this week that helped me to stay profitable in my other accounts. Also, a quick disclaimer: this video is for educational purposes only. It's not financial advice or solicitation to buy or trade any of the securities that I mentioned here in this video. This is just my trading journey, and I trade based on my own risk tolerance. Now, a brief market recap and trading performance. This week, like I said, has been quite challenging. A lot of market swings and uncertainty with upcoming tariffs, risks, mostly emanating from the US administration. Despite that, I've been sticking to my trading strategies and making some adjustment. My trading portfolio, which I share with you guys here, is slightly down, like I said, this week by 0.35%. That's because I also opened 3 long vertical core positions expiring May 30th. And I did some trades on the VIX ETF UVXY. I was able to make some profit. I think net it was about $80, but overall the market has been pulling back, which is affecting those trades for now, but I still have some time. I'm still writing covered calls on Walmart since I hold currently 100 shares in this portfolio, right? And I did a video to explain what a covered call is. I plan to hold the long vertical calls for the next 21 days and see if they gain value. If not, I'll cut my losses and move forward. Now, these are just small positions relative to the portfolio size, and I will put them on the screen here so that you can also see. Now, I just want to do this in the interest of transparency. For those who don't know, what is a long vertical call? For those unfamiliar, a long vertical call spread is a bullish option strategy. Basically, what I've seen in this market is that it's very risky to take naked options, and generally I don't like trading naked options, right? So what I'm basically doing is I'm increasing my range of value and increasing the probability of being right. If I'm just right on the direction of the market, let's say I take an individual stock, let's say SPY. I'll give you an example here and put it on the screen here for you to see. And then if I take, let's say I take a call basically it means I am bullish. I believe that it might go to a certain point. But instead of just saying, okay, currently SPY is trading at $568.83 as I'm speaking to you now, and it's up 0.3%. But if I take a call, just a naked call, I would say, okay, I'm gonna pay a premium, let's say $200 to buy this one call option, let's say for it to hit, let's say 570. If it doesn't, or if it goes to 570.69, then I'm not going to make money. But what I've seen with vertical call spreads and also vertical put spreads, basically, if I believe that the stock is going to go up, I'm going to take a vertical call spread, like in this case. If I believe that the stock or the security is going to go down, I will take a vertical put spread. In other words, I'll have 2 strike prices, right? That I will have same expiration date. But let's go for an example. Using SPY, which is the ETF, exchange traded funds, that tracks the S&P 500, which is a basket of the 500 companies that are publicly listed in the US that come from different sectors. Now, let's say I bought a SPY call for 567. strike price. That means if it hits that by May 3rd, right, for 1,867, right? But on the options strategy, on the options chain, it will show like 18.67. Bear in mind that one option contract will have 100 shares of or 100 units of the underlying security. So in this case, that would be, let's say, equivalent to 100 shares of SPY in principle. To say if the 100 shares of SPY move, let's say if one share is the same, right? If it moves, let's say by $1, or then the option will have a more amplified, version. Now, if I sold a call, basically, if I sell a call, I'll collect premium, like what I do, right? If I sell a call for expiring May 30, I would be paid 153. And like I said, if I buy a call option for May 30, that expires on May 30, but with a strike price of 567. Because right now it's in the money, it would be more expensive. So I would pay 18.67, which is 1,867 when you pay the money, right? But then because I was paid $153, I subtract. So the total risk in that case would be 1,700. That would be $1,867 minus $153, right? And my maximum profit potential in this case, if this trade moves in this direction, could be $2,686. But again, this is just simulated profits, right? So the risk reward ratio here is quite high if I am right. But options, they come with some complications. There's delta, there are these Greeks. So sometimes when the option gets towards the expiry date, sometimes it decays, it loses value. So usually my rule of thumb is I like to close the trades once I see the profit, let's say up to 50% or even 10-20%, maybe in a week or 2 weeks, I close the position and I exit. If I'm wrong, I cut my losses and move on, right? So think of it this way. If I had bought, let's say currently SPY now is trading, it's now $569.21. So if I bought 100 shares here, I would need $56,917, right, to buy those shares. So right now, if I'm just trading, I'm using $1,714 instead of the 57,000, roughly, let's say. So that's the thing. I'm just taking a small position, but still, if I'm right, I could really make money. The problem is, if you are wrong, then you get you get whacked. But for this trade to be fully profitable, SPY needs to rise above, to get to maybe, let's say, 611. So that means even though it can start to go in that direction, I would realize this full profit, right? If it goes and, let's say, by April 30 or before it gets to 611, I could make, if I take this trade, $2,686 on 1,740. The other way to look at it, if it reverses, it goes in the opposite direction, I could lose $1,714, right? That's the point. That's the way that I like to look at it, because our brain usually is wired to say, oh, I will make 2,700 if I risk 1,700, right? Yeah, if it works, but rarely, if you look at it, the probability might be 40%, right? So I just like to take, if I take profit off the table, let's say 30%, 40%, or even 10% or a profit, I put a trailing stop loss. And by the end of the day, if it doesn't hit my stop loss, I close the position for a profit. That way, I preserve my capital, but I also make some profit. Now, here are the lessons that I've learned this week. Even though my portfolio took a small dip, I learned a few key lessons. Number one, keep more cash. Having cash on hand allows me to capitalize on swings, right? I took a trade on a top tech stock last week, right? I closed the position today for almost $950. And if I include the covered call premium that I got, that's a 1,000 in a week, right? So you're investing, in that case, I took a trade for $21,000, right? And then by the end of the week, I closed that position with 1,000, let's say 1,000 US dollars, right? But the thing is, I'd seen that it retraced. I used technical analysis and fundamental analysis. So my focus is on fundamentally strong companies. And I only take swing trades on strong, fundamental, and sound companies that I would otherwise want to hold. So I can write covered calls, and if they hit the price that I like, I can close the covered call and take the profit and take the money off the table. Why? Because there are the tariff risks. On the other end, there are also opportunities because people generally tend to overreact. So what is clear is that these tariff talks and impacts and other macroeconomic environments or news, they are really affecting stocks. And on the other hand, it might be a chance to buy great companies at a discount for long term. So that's something that I'm looking at it. But bear in mind that I like to do deep dive, to go into the security exchange filings, to look at their financials for the past 5-10 years. That's my strategy for the long term. Okay. Now, in terms of the next steps, here's what I'm going to be doing next. Holding the 3 long vertical call trades for the next 21 days. If no profit, I'll exit. If I see profit even after a week or so, I'm going to exit and take the profit. Now, I'm going to continue selling covered calls on Walmart to collect premiums. But at the end of the day, things in the market can rapidly change. So I'm watching the market pullbacks to buy wonderful companies at a discount for the long term, because this is just the way that I think it's going to be for the next 4 years, at least, if President Trump continues on this trajectory of continuing to bring these tariff talks for whatever reasons. Is it for trade negotiation? But as a retail trader and investor, my goal is to try and see how I can make money from this volatile market. I observe what happens politically, Canada, the US, globally, but my goal is to try and synthesize all that information and see how I can be profitable trader and retail investor. That's really my goal. That's really my job. And that's what I've been trying to do. It's extremely difficult, but I really enjoy taking these challenges. Now, final thoughts and a wrap up for you guys. This challenge is about learning and adapting, but also improving my strategies. From time to time, I learn, I make mistakes, I move on. But the most important thing is to not make ruinous mistakes, because if you blow the account, then that's it, right? So my goal is to survive this coming week. I'm recording this on Thursday. Tomorrow might be another interesting day. There's core PC data today, there was GDP data, there's a lot of things that happen, but the goal is to survive day by day. And I used to wonder why on the Bloomberg TV that I watch most of the time, I see traders from New York Stock Exchange, when the market closes, they ring the bell and they clap hands. For me, the point is, it's appreciating that, well, the markets have presented opportunities for me. That's the way that I see it. But at least I survived this day, right? For me, the goal is to not blow the account, to grow the account ultimately. But if I don't blow the account, like I'm consistently growing the account, if I'm 15% up, right, in, let's say, 2.5 months, at least, or 3 months, for me, that's great. The S&P 500 right now is almost like 10% down from when it was. So if you look at that, I'm really beating the S&P 500 in that case. That satisfies me, but that does not make me complacent, and I'm just small retail trader who is looking for opportunities in this tough market. There are always opportunities, but you just need to use the right approach. So let me know if you have any comments. Have you traded long vertical calls before, or long vertical put spreads? How are you handling this volatile market? Hit and subscribe button if you found this video helpful. I will see you in the next update. Trade and invest wisely, and may the markets be on your side. Bye bye for